This video is going to show you how to do a trailing stop on the InfinityAT DOM. So here's what we're looking at. On the left-hand side, this is a March E-mini S&P futures contract DOM. Here in the middle, we have the March E-mini NASDAQ futures, and the chart in the background is the mini NASDAQ, and you can see it's making a high here. Okay, so what I'm going to do is set up a trailing stop on each of these products, and we're going to do an order in the opposite direction because obviously we want to get some example of the stop actually moving, and unfortunately we can't predict where the market's going to go. So we've got the NASDAQ in the background. Let's just say hypothetically we want to do a long trade in the E-mini NASDAQ and we want to attach a trailing stop to it. So here's what you do. Firstly, select trailing stop in this drop-down menu right here in the left-hand margin of the DOM. All right, you see that right there. When you do that, you're going to see three options appear right below: trigger, stop loss, and distance. Let's start with the stop loss because that's the easiest one. That's just your initial stop in ticks. So for example, what I'll do for this example is I'll put the stop loss at 12, which is 3 full points in the E-mini NASDAQ since it's ticks and quarter points. All right, so we've got a stop loss of 12. To the left, the trigger is the number of ticks we want to make before the stop starts to trail. So stop loss, that's just our initial stop loss, easy. Trigger, the number of ticks we want to make before the stop starts to trail. Let's say 3 in this example. So we're only looking for 3 ticks in our direction once we get into the trade before the stop starts to move. The distance, once the trigger is reached, how far behind the market do we want the stop to trail by? Let's say 5 ticks in this case. I want to caution you against using a really small number like 1 or 2 for the distance, especially in a volatile market like crude, the Russell, or gold. If you try to put your stop so close to the market, there's a possibility the stop is rejected by the exchange as an invalid price. So generally speaking, we like to see this number bigger, closer to 10, even under normal market conditions, but use your judgment. If you have any questions about order types, how an order can be rejected, make sure you talk to your representative before you start using this feature. All right, so we've got everything queued up. We've got a stop loss of 12, trigger of 3, distance of 5. All we need to do now is make sure auto is checked. Okay, auto is what controls whether or not this trailing stop or bracket or any other type of automated functionality is going to go out once we get a fill. So we have auto checked. What I'm going to do is put these same parameters in for the S&P on the left-hand side of the screen. Check auto. We'll queue up a quantity of 1 in each of these. And on the right-hand side for the NASDAQ, we're going to buy, and we're going to sell here on the S&P. So on the NASDAQ DOM here, you can see we're long 1. We already made our 3 ticks, and the stop has already started to trail. That was a really quick move. So you can see now on the right-hand side, the stop is trailing tick for tick each time the market makes a new high. So if we print another tick higher, which I believe will be 65 and a quarter, we're going to see the stop move up another tick to 64. Actually, there we go, one more tick, and there it goes, keeps going. See that? So this is a good example of how the trailing stop can work in a fast market condition. It's a lot easier, I think, to use this type of functionality rather than try to do it on your own. Although we do have a lot of clients who will just go ahead and manually move their stops like this, which you can do as well. So it's really just a matter of what you want to do. Again, the key with this type of situation is to not use so tight of a distance that A, your order is rejected flat out because it's too close, or B, you get stopped out immediately. All right, you can see we did get stopped out of this trade. The open trade value is back to 0. We grossed 15 simulated dollars on that trade, and now we're flat the NASDAQ. The S&P over here, we're still short. The stop is still in its original location, 12 ticks away, because we haven't made 3 ticks of profit yet. All right, so let's go back to the NASDAQ here and try to catch one more. So I'm going to go ahead and buy 1. The stop immediately goes in 12 ticks below the market. Okay, the market's moving against us here a little bit. What we are looking for is the market to print 3 ticks of profit, which in this case would be 67.75. If that happens, which it just did, see that the stop immediately jumps. And now it's going to move tick for tick with the market as it goes in our favor. So again, it's tough to do this in a live market situation because we can't see the future. But here, very quickly, we made 3 ticks, and the market, or the stop order, immediately adjusted to 5 ticks behind the current price. And now it's moving tick for tick with the market. All right, down at the bottom of the screen, you can see the open trade value here in the left-hand box. That's going to continue to increase as long as the market keeps moving in our direction. And as long as the market prints a new high, the stop order will continue to trail 1 tick at a time. Or if the market comes down and prints at 67 and a quarter, will immediately be stopped out. So again, just looking back at these parameters as a reminder, stop loss, that's your initial stop, that's the easy one. Trigger, the number of ticks you want to make before the stop starts to trail, which it still is, by the way. And then distance, once the trigger is reached, how far behind the market do you want the stop to trail by? The smaller the number, the tighter the trailing stop. The bigger the distance number, the wider the trailing stop. And again, just as a reminder, use caution if you're trading volatile markets like crude oil, especially the Russell, gold, anything with a very, very thin bid and offer depth of market. You're more likely to see order rejections in those situations, especially if you use a super low number for the distance. So make sure you talk to your representative about the risks of doing that. But here, this example in this simulated environment is working very well. The stop is moving tick for tick every time the market prints a new high. And from here, we could either just flatten the position, let it stop ourselves out, take ourselves out manually using the flatten button, and we're out of the trade.